Welcome to my first live on my channel. I'm super excited to share with you a presentation that I'm going to be giving here shortly. I'm practicing on this platform. And my name is Paris Clough, and as you've been probably watching my YouTube channel for a little while, you know that I'm a certified financial educator, and I've been in financial planning and financial services for over 20 years, teaching people, helping people understand how to protect their money, how to manage, protect, and grow their money. And I'm super excited to be able to bring to you what I call financial literacy: the 7 steps to creating lasting wealth. And so I'm going to share with you my screen here as I go through this presentation. And if anybody is on and wants to have a question or two, go ahead and ask, and I'll do what I can to make sure that we get those questions asked. But this is an opportunity for me to practice a presentation that I'm going to be giving as a seminar to several people that I'll probably be recording as well and adding clips to my channel from time to time. So super excited to be able to bring this to you, and let's go. And so what I wanted to share with you here is, let me share my screen. Okay, so the first thing I wanted to really reiterate, and you've heard me say this many times in several of my videos, your mindset really changes everything. And your mindset has almost everything to do with your success in life, and that includes your financial successes. So it's really important to realize that financial success comes with your ability to believe what's possible for you. So let's start with our financial psychology or our mindset. In fact, it's interesting that right now the certified, what do they call them? The CFP board, or a lot of the financial planning boards are actually using financial psychology or adding financial psychology, behavioral psychology into their curriculum to teach financial planners how to really understand the behaviors and the emotions and the things that go into people's decision-making process when they make decisions about their money. So the first thing I wanted to kind of go through here is our emotions, our needs, emotions, and the money connection. So money, I've said this many times, that money has a lot more to do with our mindset, with our beliefs, with our emotions than it does with math. A lot of people, when I talk to them about their finances, they'll say, Paris, I just don't understand math. Can you help me with my finances? And I say, actually, money does have, obviously, there's math to do when it comes to money. There's calculations, there's addition, subtraction, whatever. But the reality is that most people make spending decisions not based on math, but on emotions and on behaviors and on beliefs. If everybody knew that if they only had $100 in their bank account and they went and spent 150, that's the math there, is that they don't have enough money to spend the 150. But if all of their friends are doing it, or if they're going out and they're trying to get involved with something, then they're going to make those decisions and they're going to buy it anyways and put the $50. They're going to pay for it with 100 and put the 50 on the credit card, and then they're going to continue to go into debt because of those emotional choices, because of they've decided emotionally, not logically or with math. So, emotions have a huge part to do with your finances. Your sense of well-being. Maslow's hierarchy of needs shares with us that a lot of our worth, our self-worth, comes from a lot of different things: how people treat us, that the love that we receive from our family, our parents and friends and things of that nature. But it also has a lot to do with how much security we have, how much safety we have, and the basic needs of life. Most people, once they get their basic needs met, then they can start thinking about greater things, or different things, or other things. And so I've met with a lot of people over the years that they're struggling just to put food on the table, and they really don't have time to think about anything else. And so one of the things I've also realized is that a lot of these social issues that we have in the world today come because there's so many people that are in poverty, that if we bring them up out of poverty, now they have time to think about saving the planet or saving the world or other things. So there's a reality here to the hierarchy of needs and financial planning. We need to understand that if you really want to make sure that your money is doing the right thing, you've got to have these, you got to realize that money is connected to our emotions in a very significant way. So it's also connected to, different things, like when you're doing your bills, how do you feel when you do your bills? Are you frustrated? Are you feeling sad? Are you feeling overwhelmed? Or when you're doing your bills, do you feel excited that you can make those payments because you have plenty of money? Or are you sad and frustrated because you don't have enough money and there's more month at the end of your money than there is money at the end of your month? So one of the things that's really important to realize is that as you're thinking about money, and a lot of people, when they think about money, they think about what the Bible says is that it's easier for a rich man to get into heaven. It's easier for a rich man to go through the eye of the needle than it is for him to get into heaven. And so there's a lot of money is the root of all evil. There's a lot of these feelings that we associate with money that are negative. And the reality is that we need to associate positive emotions with our money so that we can actually move forward. Um, and, it's, if we don't have a positive emotional experience with money, money is probably not going to want to hang out with us, or really be attracted to us. So with the reality of having, um, your so it's important for you. What I'm saying is, it's important for you to kind of check, or put into check, what do you feel when it comes to money? When somebody says it's time to pay the bills, or when a bill comes in through the mail, what are some of your first emotions and feelings that you have as you do that? And that will help you determine what your relationship is with money, and help you develop a more positive emotional experience with your money. Money is a tool. Money is a powerful tool, and it can do a lot of great things in the world. There's a lot of things I'm sure that each one of us want to do, that not necessarily do we love to make money or work, but we love what money brings, what we can do with that money, and how we can help others with that money, after we've, of course, helped ourselves. So emotional experiences around money, um, are critical to kind of note and take note. So, um, the other thing here is that, where do we learn our financial experiences? Where do we learn about money? And it's typically one of the big taboos. What you don't, at the kitchen table, you're not supposed to talk about religion, politics, or money. And I think that's kind of nonsense, because if you talk about those things and you articulate those things, you get better at understanding what they are. And the best way to understand something is to think through it. And we think by speaking, we think by having conversations, we think by going through processes where we're talking about certain things. So, it's important to realize that a lot of the things about money came from your parents, and then from your friends, as you watch your friends do things. And maybe your friends had parents. There's an old book, I'm sure that's pretty famous. Robert Kiyosaki wrote the book called Rich Dad, Poor Dad. And of course, that book clearly indicates that he had a friend with a rich dad, or he had and he had his own poor dad. And so his parents in that book were his primary source of information about money. And he compared the two, and the one dad taught him how money worked, and how that it was a tool, and that he could use that to become wealthy. And the other dad was kind of a poor mindset, and really helped him, and really kind of gave him that contrast. And so it's important to realize, where do we learn our financial habits? Family members. And another thing too is, it's really big for this, is advertising influences. A lot of you may not know this, but there's people with PhDs, MBAs, and all kinds of letters behind their name that are trained specifically to help you uh, separate yourself from your money and buy their goods or service, or their widget or gadget. So it's important to realize that these social media experts, society, cultures, the consumerism culture that we have, it's actually designed against you if you have the desire to save and become wealthy. Because in consumers don't become wealthy. People who save become wealthy, and then people who use their money wisely. And we'll talk more about that as we go on here. So here's another breakdown here. This is a interesting mathematical equation here. Financial behaviors, the equation. So parents and caretakers, plus advertising, plus peers and influencers, plus personal experiences, plus no financial education. I mean, when was the last time we really had any financial literacy in schools, and or at church, and or any university? Really, I went through and I got my degree in business administration, and there was really no personal finance or financial literacy course that I got to take. There was accounting, sure there were some things like that, but there was really no, like, how do I invest? Like, how do I budget my balance my checkbook, things like that. So financial literacy is really you're on your own, and or you're watching YouTube channels like mine, or going to presentations like mine, or just being out there amongst different people who are trying to make, different salespeople in our industry, and they'll teach you things in hopes that they'll get you to buy something from them. And there's nothing wrong with that, but a lot of times they have an ulterior motive, because they want you to buy something. So this can lead to, again, financial insecurity, stress, and long-term problems. So it's important to be able to realize that you're influenced quite a bit by your money. And so you got to, and by other people around, what to do with your money, especially your friends. So one of the things to ask yourself is, you're learning from someone else about what to do with your money, are some of these questions here. Are they living your desired lifestyle? So does the person that you're looking to for advice in financial world, do they live the lifestyle you want? Can you relate to the information they share? Do they motivate you? And so a lot of times, I think it's funny, the financial services world has financial professionals, they call them brokers. And I thought I've always, I actually used to be one, but I think it's funny because I don't want to get advice from a guy who's broker than me, if that makes sense. So that's kind of a joke there, but you want to make sure that people that are going to mentor you in life financially have already and or living the lifestyle that you want to have, because you don't want to get advice from somebody who's at the same level as you. I remember it when I used to work at in the corporate world. I had a job, and it was interesting because I would ask my coworkers some of the things that they would do with their money and how they would manage their money. And often they were just in the same situation I was. So it really wasn't giving me great advice because they were in the same place I was. And so they had, it was interesting. I asked one time when I qualified for the 401k at one job I had, they said, I asked some of my coworkers, what did you do to pick your stocks? How did you pick which stock to invest in? And they said, well, we just flipped a coin, or we just went with the company stock because that was the easiest. And I thought, well, that's not how I want to invest my future. I don't want to invest my future in things like flipping a coin, throwing darts, slash, just picking the company stock because it's easy. So one of the most important things about psychologically and mindset, the mindset around money, is setting goals and having dreams about what you want to do or what you want to accomplish with that money, because it's the why that will get you through any. I think it was a famous psychologist that said, if you have the right why, it can get you through any how. And that's one of the reasons why it's important to have goals and dreams when it comes to your money. So what I would recommend is write down your goals and dreams, organize those goals and dreams into priorities, and then create a plan. Because if you don't have a plan toward the attainment of a goal, that goal is just a pipe dream and it's not going to get you anywhere. So you definitely have to have a plan. So for example, if you want to have a plan, if you have a goal to save $5,000, then you need to have a plan of how you're going to do that. And that's something that's critical. And then you've got to review your goals often. So keep accountable to those goals, and then see it and believe it, meaning visualize you obtaining that goal already. So there's some psychology behind the attainment of goals and making sure that you're getting where you need to be or want to be in life. So this is an acronym that a lot of people know, setting SMART goals here. As you can see, SMART. So the goals should be specific. That's S. They should be measurable and motivational. Specific goal is, an example of that is, don't say, I want to save a lot of money, because what is a lot of money? So a specific goal would be, I want to save $5,000. Make it measurable. That's 5,000 is measurable, attainable, results oriented, and it should be time driven. So when do you want to have that goal? So that's the why, the SMART: specific, measurable, attainable, results oriented, and then time driven. So that's why the SMART acronym is there. So then balance those goals too, because it's important to realize that part of the reason why you're making the money is so that you can enjoy your family, so that you can have health. There's an old proverb, I think it was Arabic or somewhere, that your wealth is in terms of if there was a number and you were to be able to put your life in that place, your health is the one, and then all the things that you accumulate are the zeros behind it. So if you take away your health, then you have just a bunch of zeros, and so you have nothing. And so it's important to make sure that your health is a priority. And so you don't want to stress yourself out. And the number one cause of stress, or one of the leading causes of stress, is mismanagement of your money and not understanding how your money works. And so that's where it's super important to get control of your emotions, so that you can get control of the stress that's around money and be able to have the health that you want. So important ways to different things to balance your goals across all areas of your life. It's super important. We just talked about SMART goals. So here's an example. I will save $500 for a plane ticket to my grandmother's birthday. Measurable: I will save $125 out of each weekly paycheck. Attainable: I have the spare funds. So that's what we're going to get into next, is budgeting. So it's important to be able to budget. Results oriented: you want to walking in the door will feel great, and I will complete this goal in 4 weeks. So if you get paid every week and you want to take 125 times 4, that's $500, and you got your goal. So I wanted to just share a little bit about the difference between financial independence and financial self-reliance. I think that financial independence means that you have the freedom to do what you want. So you're independent. You can do what you want. Financial self-reliance to me means that you have the capacity, you have the skill sets, and where you can produce whatever you need from your own skills. And so it's important to realize that why I chose the word financial self-reliance is because I wanted people to be able to have the skills necessary to be able to change their current situation. So let's jump in here to number two, which is budgeting, or what I call cash flow, understanding how cash flow works. So most people, the flow of their cash or the cash money in their life goes like this. They earn money, they spend it, they borrow, and then they spend more. And that's actually the cash flow process of the poor. The cash flow process of the wealthy is they earn money, they save a percentage or pay themselves first, is what it's called. And then they'll spend and use their bills, and then they'll invest what's left over. So they have that ability to make enough money that they're living within their means, and then they save enough money that they can have a future and pay themselves first. It's important in doing that to understand that your wants versus needs. A need is something that you must have for survival: food, electricity, gas, water, toiletries, clothes, shelter. And a want is something that's extra, that's above and beyond that. It's not essential to survival, but it's something you'd like to have. Designer clothes versus just regular clothes. Vacations, a fancy watch versus just a watch that tells time, a super fancy car maybe versus a car that just gets you where you need to go. And so it's important to realize needs versus wants. Needs are first. Once you've fulfilled your needs and your basic needs are taken care of, then we can start working on wants. And I love this quote, there, little luxury, don't you cry. You'll be a necessity by and by. What's interesting, have you ever noticed that as you see friends buy certain things, you have to now have them yourself? Like that, it becomes a need because you want to be in the crowd that has the cool stuff. And it's interesting because my family, everybody in my family has an Apple Watch, and my son didn't have one. And he's like, Dad, I want an Apple Watch. Everybody's got an Apple Watch. That was one of his reasons why he needed to have an Apple Watch, because everybody in the family had an Apple Watch but him. And so that's part why that psychology, that mentality is that sometimes if you convince yourself enough, something that is a want will soon become a necessity or a need based on not really based on the actuality of it being a need, but based on your desire to have it. So the benefits of budgeting your money: gives you control of your money, keeps you focused, helps you stay aware of where your money goes. Accountability is key. Awareness brings change, and awareness is really the key. Then there's some great things here as well. So what you want to do when you're budgeting is you want to make sure that your income is greater than your expenses, and then you want to save the difference. So what I do is, let's just jump here a couple more here. So budgeting is about saving money. Better budgeting helps you end up with more money to manage. What I like to do is I help you identify and reduce your expenses, because once you learn to live within your means, then it's important to grow your means. So first of all, getting disciplined with your spending is critical. So let's talk about what I think is the most essential way for you to build a budget, and that's with what I call the 90-day look back. So what I share with people is that you want to, in order to really set a budget going forward, the best thing for you to do, well, in life, if you want to go somewhere and get somewhere and you have a goal, you have to know where you are already. And then a lot of times, knowing where you are already, you have to look back and see where you've been and where you've come from to know where you are. So the 90-day look back allows you to see what you've done with your money over the last 90 days. So I tell my clients to take all their statements, their bank statements, their credit card statements, anything they've spent money, all their statements, and put them in month by month, but to go back 90 days or 3 months. So let's say, for example, that it's, right now it's January, it's February. So, and if you were to do this at a 90 look back, you'd take your January, December, and your November statements, and you would look and see how much you spent in each category as you go through your statements. So you could see, oh, you bought money, you paid your mortgage, you paid your rent. That's a category. Maybe you went out to eat. That's a category for entertainment or food. And then maybe you went to the grocery store. That's a category for groceries. Maybe you bought some personal items. Everything that you bought, go back through for the last 90 days and put that down on a budget sheet, and then keep track of that moving forward. But going back, what you want to do is you want to look and see, what are the fixed costs, what are the variable costs. And the reason why I say 90 days is because you want to be able to have an average. And so if you look and say, okay, in November, I spent this much money on this category, and December I spent a different amount, and then January I spent a different amount. What you want to do is average that amount over those 3 months, and then you'll know moving forward what you can do. Hey, what's up, Debt Free Dad? Good to see you here. And so it's important to realize that when you're doing your budget, you want to separate it between fixed costs and variable costs, and then the periodic costs are those things. And we'll get into that here in a minute. So let's start with fixed expenses. So an example of a fixed expense is your rent, your car payment, your insurance payments. Those are fixed costs that don't change every month. And they're basically the ones that you have to make every month, regardless. You can't stop making your car payment, or, well, I guess you could, but they'd take your car away. If you stop paying your mortgage or your rent, you'd be, you'd be kicked out in short order. So, some fixed expenses can be things like gym memberships, but the thing you want to do is you want to separate out all of your fixed expenses, because those are going to stay the same every month. So that's going to be an easy item to budget. It's easy to budget your mortgage because it should be the same every month, or your rent. It should be the same every month. Now, I know lately they've increased the rents, but this should be a very simple calculation. The next one is periodic expenses. So for example, every year, you may have, especially if you purchase things on an annual basis. For example, I buy my health insurance with the annual premium because I get a discount from the monthly premium. I buy my car insurance the same way. I get 20 or 30% off because I pay the annual premium. If you do that, then you want to make sure you're budgeting in those that you want to take the total annual premium, divide by 12, and then you want to build up a savings account so that when that bill comes, you have enough money to just pay it all at once. Another thing that's a little more, especially in California, you got to save up for it, is car registration. It could be hundreds of dollars to just register your car, and that usually comes up only once a year. So putting aside money every month for those types of things is critical. And then variable expenses are groceries, eating out, entertainment, even gas. I know gas fluctuates in the price, but how much you drive every month will determine how much you need to have set aside in a budget for gas. So budgeting for things that are variable expenses, that's where you'll see the fluctuation. This is really kind of the important area for you to focus in on first, especially as you're setting the budget. You want to be able to set the budget by looking at each of those 3 months and then creating an average, and then moving forward, the variable expenses are the ones where you can start looking to make some reductions. If you need to reduce anything, you're going to have the best luck reducing your costs and your expenses in the variable expenses category. You can't really reduce your rent or your mortgage if your income is, say, $1,000 a month, and all of your expenses are $1,000 a month, you're at zero. Like, you have no cash flow. You have no positive cash flow. So to get to a positive cash flow, you're going to have to either make more money or reduce your expenses. And there's only a certain amount of reducing you can do on expenses before it really is going to become obvious that you need to just make more money. So the idea here is that the first things that you can reduce, if you do need to reduce any expenses, are those variable expenses. That's why it's important to categorize those into different things that you can do. So the first, as I shared with you, I had 7 steps to creating lasting wealth. The first one is understanding your mindset and the emotions and beliefs and behaviors you have. The second one is understanding cash flow, understanding that you need to make more money. You need to have more money coming in than going out, and tracking that is critical. Most millionaires, I don't know if you know this, but about 70% of millionaires track every year. They know exactly how much money they spend in every category on their budget. And so they're very frugal, and they're very budget oriented in general. So just because you're you think people are millionaires, they just spend whatever they want, do whatever they want. They don't. They actually track, and they're very, very specific about it. So let's jump into the third step here, which is proactively saving and creating a savings plan. Because once you have your budget in place, once you know how much money you're spending every month, and once you have an idea of what your income is, then you can take that difference and use that towards getting a savings plan in place. And savings is the stepping stool towards investing. If you don't know how to save, you're not going to learn how to invest. And if you don't know how to save and invest, you're never going to actually obtain financial independence. And being able to save comes from understanding your cash flow and budgeting properly. So a lot of people say, I don't like the budget. It's boring. It's arduous. It's toilsome. I agree. Budgeting is no fun, but you have to do it because that's the only way you're going to know how much money you have to save. And then that's how much money you're going to know how much to invest, so that you can actually someday get out of the rat race. So I love this quote by Brian Tracy. It says, the ability to discipline yourself to delay gratification in the short term in order to enjoy greater rewards in the long term is the indispensable prerequisite for success. Discipline is key. If you want to have success in life, you have to have discipline. And it's so super important. So thanks, Marcus, for that. It's important if you have annual spending, you've definitely got to have that budget in place on a monthly basis. Take the annual amount, divide by 12, and then put that together for yourself. So let's jump into the 3 areas of saving that I think are critical. And the first one here says emergency fund. I think of emergency fund as more of midterm money. So I'm going to start with short-term savings first. Then I'm going to jump over to midterm savings in the emergency fund. And then I'm going to jump into long-term savings. So the first one here is short-term savings. To me, that's money that you set aside for things that you're going to buy right now or in the next 30, 60, maybe 90 days. So if you have something that you want to buy, for example, you want to buy a big screen TV, you want to buy a new car, you want to buy some new clothes, you want something you're going to buy, like you actually have a plan to buy something in the near future. That's something that you would have as a short-term savings plan. You take the money every month and you save up for it. So let's say, for example, you want to buy a new TV and it's $500. And let's say that you have an extra $100 a month. Well, if you do it right, that means it's going to take you 5 months before you can buy that TV, because you're going to, the idea here, the successful people with their people who are successful with their money, they save first and buy with money they already have. They don't go into debt and then end up having to pay 25 or some odd ridiculous interest rate to eventually, buy if you were to buy a $500 TV now, it would probably cost you $600 or so if you had to pay off $100 a month on a credit card. So that's why I say save up the 5 months first, take the money and go buy the TV with the money you already have in savings. And one of the things that I highly recommend is that you get in the habit of evaluating and prioritizing your wants. That's where, if you really want something, put it on a list. Like, for example, what I tell my kids all the time when we go to buy stuff at the store: Dad, I want to buy this. How many of you have kids that are like, I want to buy this, Dad, Mom, whatever. I say, put it on a list. And if in a month it's still on the list, or they still want it, or they look at the list and they're like, yeah, I really don't want that anymore. It wasn't really a want. It was just something fleeting, some impulse purchase that they were influenced to buy. So beware of those impulse purchases. If you save up money over time, you're going to realize how hard a work it is to really, and you're going to respect that money a lot more, and you're not going to be willing to just spend it frivolously on impulse buys. So having the discipline to do that is critical. And I think one of my favorite things to do is have what are called sinking funds. A specific fund designed for that particular situation. For example, I have a sinking fund, which is an account, a savings account that's specific to Christmas. So every year in January, I start saving money towards, I have a goal of how much money, and I usually base it on what I did last year for Christmas. And so this year, my goal for what we're going to spend in Christmas in December, and this video, I'm recording it in February. So in January, I put aside the money for January, February. So I divide it in 12. And so every month I put money into my Christmas fund. And then I put it into a savings account that actually gives me a significantly high yield, or a high APY, or annual percentage rate yield. And that's critical. You want to have your savings in an account that's going to give you a decent rate of return, a good rate of return, and at least what inflation is doing. Right now, as of the recording of this video, February 2023, inflation, I think the base rate for inflation is ridiculous, but I think the Fed rate is about 4.5%, 4.25%. So you want to at least be earning 4 or 5% in your money there. So critical. The next thing you want to do is emergency fund. Now, there's a lot of talk about emergency funds, like what's the proper way to develop an emergency fund? How much money should you have in an emergency fund? And they say 3 to 6 months worth of money. And one of the things that I like to talk to people about is, first, to start with your fixed expenses. So remember, we talked about in the budgeting section, we talked about your fixed expenses, like your mortgage, like your car payment, like your insurance payments. Your cell phone is actually kind of a fixed payment, as far as I'm concerned. So take all of those and multiply those by 6 first. Your groceries, your gas, your discretionary things, those kinds of things should be second in your calculation, because you want to get to 6 months of the fixed costs first and then build up your 6 months of those discretionary things. One of the things that I like to do is one of the things that I like to tell my clients is that if you were to lose your job tomorrow, and how long do you think it would take you to find a new job? Now, the rule of thumb in the industry, or in what job hunters say, the rule of thumb is for every $10,000 of salary you desire to attain or have, or to get a new job doing, that's going to take you 1 month for every $10,000. So if you need a job that's going to pay you $50,000, it's going to take you 5 months. If you need a job that's going to pay you $100,000, you're going to take about 10 months to get there. So the idea is with emergency fund is that how long, the real reason why emergency funds kind of got started was, what is your lifestyle going to be if you were to lose your job today? What are you going to be able to do to keep yourself afloat until you find a new job? And that's kind of the idea, the real idea, foundational idea of an emergency fund. Now, of course, things happen even when you have jobs, like you get in a car accident, have a deductible you have to pay, or a health concern, or maybe you get sued or something happens. So money can be used in emergency fund. For emergency fund money can be used for those things too. But the real kind of foundational reason for an emergency fund is to get yourself, keep yourself afloat between jobs as you're looking for the next job. And so it's very important to, and so if you did lose your job, one of the first things you can do is cut expenses. You don't have to travel as much necessarily. You're not driving as much, so you can cut back on the gas. Maybe you're not, maybe you can cut back on how many cable TV channels you have, or how many subscriptions you have, or maybe cut back on some of these things. You can't cut back on your mortgage, your rent, your car payment. You can't call them up and say, hey, I'm out of a job, for the next 3 months. Can you put it on hold? They just don't really do that very easily. So that's why I say get those fixed costs first. Because a lot of people, when they think of 6 months of what they spend, that's overwhelming, and they don't start because they think it's too much, and it's just overwhelming. And so they're just say, forget it, I won't even start. So if I share with you that, what if you just took your mortgage and get 3 months of mortgage payments in your bank somewhere, or in a bank account? That sounds more manageable. It sounds more doable for people. And then once you have 3 months of your mortgage, get 3 months of your car payments, and then get 3 months of your cell phone payment, then get 3 months of your insurance payments, and then get 3 months of that. And then once you have 3 months, go get 6 months. And so if you take it in steps, bite-sized chunks, it's easier to develop and create an emergency fund. So again, this is something here, sudden unemployment, something I've already talked about and shared with you on this. So thank you for being my guinea pigs with this presentation. Some of these slides I'm realizing I probably don't need to have in here as I give this seminar and presentation. So I'm kind of working through that. So long-term savings. So long-term savings is anything that's going to be 5 to 10 plus years from now. So if you're going to, a lot of people want to put their children's education fund in a long-term savings account. They want to put their retirement in that kind of a fund. So it's important. Sorry, I got a phone call there. So it's important to put the money in the right place. For example, when I sat down with a lot of clients, I would talk to them and say, okay, so how much money do you have in your checking account? How much money do you have in your savings account? And they would say, well, I have, X thousands of dollars in my savings account. And I'm like, well, what's that for? And they're like, well, it's for, it's for my retirement. It's my kids for savings. I'm like, that's you have long-term money in a short-term account or a midterm account. So you want to put, it's important to have these, it's important to put your money in the right place. For example, high yield savings accounts are short-term and midterm money. High yield savings account, perfect place to put those. Stock market, index funds, ETFs, mutual funds, that's the place you want to put your long-term savings accounts. That long-term money goes in those places. So the goal is to get to the point where you're eventually saving about 10% of your income towards those long-term savings events. Now, if you're part of what's called the FIRE community, which is FIRE, or Financial Independence Retire Early, you realize that 10% is not even going to cut it close. So you need to, the people in the FIRE community have figured out how to save 50% of their income so they can actually retire earlier. Now, I admire people who want to retire early, and frankly, that's a fantastic goal. But the reality is that let's at least work with retiring on time. Most people in today's world can't even retire on time, let alone retiring early. So it's very important to make sure that if you want to retire especially if you're going to retire early, that you're putting your money in the right places. So we'll talk a little bit more about that in the investment section of this module. But a lot of people I find put money into places that they won't be able to retire before 60. And a lot of people I talk to want to retire in their 40s or 50s. And then I say, well, you realize that you want to retire in your 50s, but you have all your money in a place that doesn't let you pull money out until you're 60 or older. And that realization kind of hits them, and they say, well, wow, I put my money in the wrong place. Exactly. So that's why it's important to deal with somebody or work with a financial coach or financial professional that can kind of give you and guide you along with what your goals are. So if you want to retire early, you need to be putting your money in places where you can pull it out at the right age that you want to retire. So it's it's important to live within your means and then increase your means. All right. So let's learn to, okay, I can skip a couple of these here. So the fourth thing is reduce, eliminate, and manage your debt. Thanks, Marcus. I really appreciate that. So one of the things that you want to do is realize that there's different kinds of debt. Some debts you want to reduce over time, and some debts you want to eliminate right away. And sometimes you just want to manage it. You just want to let it go and do its thing. So there's good debt and bad debt. Good debt is investment loans, home loans, business loans, education loans. So if you have a, for example, if you have a, uh, sorry, if you have a student loan, that's good debt. That's going to get you an education, especially if you're going to use that education to get a job in the field that you're in. Now, educational student loans can be bad debt if you don't get a degree, you don't get an education, or if you quit school early and you just don't use that. So be careful with blanketly putting things about good or bad things on here. So bad debt is credit cards, personal loans, payday loans, car loans. Personal loans are like money that you borrow from family, and or the payday loans that you have. Those are the worst. Do not, if you listen to anything or get anything out of this presentation, do not get a payday loan. If you can avoid those, do it at all time. I don't necessarily believe that car loans are bad debt, because this is a presentation that I got from my educational. So as a certified financial educator, I get a presentation that they give me and they allow me to use, and I've kind of manipulated a little bit. And I personally didn't agree with them putting car loans under bad debt, because car loans are secured debt. Anything that's secured should be on the good, well, not gooder, but on the good side of debt, because worst case scenario, especially if you wisely purchase the car, you've got a car that's hopefully more valuable than the loan. And if you have a car that's upside down, that is not a good idea when you have something that's a secured debt versus unsecured debt. So good debt are loans that you purchase loans used to purchase items that appreciate in value, loans used to buy assets, loans used to create revenue streams. So that's the original intent, by the way, of a credit card. Original intent of a credit card was to give businesses or people, entrepreneurs, immediate cash flow so that they can buy things and then sell them and then pay off the debt more quickly. And then it got to the point where everybody liked the idea of a credit card. So consumers just ate it up, literally. And now America is in debt up to our eyeballs, and it's just not a good situation. I think the idea behind a credit card was good, but I think that just not teaching people how to have the proper discipline around money was what's pretty much killing people, financially speaking anyways, is burying them. So typical examples of good debt are home mortgages, investments, business loans. We talked about that already, but that's secured debt. Secured debt is debt that's backed by an asset, something that you could sell to pay off the debt. A home loan is a perfect example. That's why I think car loans are okay, because if you had to, you could sell the car and pay off the loan. Bad debt here is unsecured debt. So loans used to purchase items that depreciate in value, things that you buy at the department store, things that you buy at, if you buy too many things with your credit card and then you don't pay that credit card off every month, that's definitely going to be something that's going to be bad debt. Things, if you don't need it, if it's a want and it's an impulse buy, that's another example of what you would get on bad debt. So how to pay off your debt? There's a couple of ways to pay off your debt. There's two of them that are really famous, which is the avalanche and the debt snowball. But I'm going to share with you another one called the cash flow index here in a minute as well. So first thing that you want to do is I had one client come to me and she said, Paris, I'm up to debt in my eyeballs. I feel like I'm going to go to debtor's prison. I'm like, they don't even have that anymore, but she felt like she was going to go to debtor's prison. Anyway, she was really upset about like figuring out how to pay off her debt. And I said, listen, the first thing you want to do is do you know how much you owe to the people that you owe money to? And she said, no, I have no idea. So let's start there. So listing your debts. And then a couple of people, she said, I have no statements. I have no idea. I said, call them on the phone and ask them, how much money do I owe you? And what would you be willing to take as a payment? And so she would get those amounts and she wrote it all down. And then also what you want to do is not just the amount, but you also want to get the interest rates that you're going to be paying. So one of the root causes of debt is that you spend money on a lifestyle or status, meaning trying to impress. Here's the problem with money is that we often buy things to impress people that really don't care about us at all. And so don't do that. No, nobody cares. Nobody's thinking about you. Don't keep up with the Joneses. Who cares what the Joneses are doing? If you're really going to be financially successful, you got to kind of be an individual. You got to kind of be crazy a little bit, actually, if you want to be financially successful, because you've got to go against the crowd, go against the grain. You got to go against all the advertising, all the stuff that you see on the TV and the Facebook and all the in social media. You've got to be a contrarian a little bit if you really want to obtain financial independence and financial freedom. You can't just go along with the crowd, or as I say, with the lemmings, and just jump right off the cliff. And so it's important to realize that you have to know how much money, how important it is, and don't just buy stuff just to buy it and be seen of the world, if you will. Not being aware of income and expenses. That's that first step or the second step was cash flow, understanding how much is coming in and how much is going out. It's funny to me is I used to work at Bank of America, and many years ago, and the call center, and I had a lady call in. I thought it was a joke. I swear I thought this was a joke. She calls in, she says, "Paris, I don't understand. I have checks in my checkbook still. Why don't I have any money in my bank account?" I was like, "Where's the candid camera? This has got to be a joke." So she was serious. She thought just because she had checks in her checkbook meant that she should still have money in her bank account. And I thought, that lady, that's not how it works. So you need to know how much money is coming in. You need to know how much your expenses are. You need to keep track of those things. And millionaires do that to down to the dollar every year. That most 70%, I think, is the percentage of millionaires know exactly how much they're spending. So do what rich people do, and you'll have what rich people have. If that makes sense, it's a recipe for success. So most people don't understand their loan terms. They have to deal with lost medical expenses, gambling, reduced in income or unemployment. And if you have emergency funds in place, you won't have to go in debt. Your credit card is not an emergency fund. Money and savings is your emergency fund. So here's the first most kind of famous way to pay off debt. It's called the debt avalanche. So you list your debts in order by interest rate. So let's say you have 5 credit cards, and one of them's 30%, one of them's 25, 20, 15, and maybe you have a 10%. So you list it in order, and the one with the highest interest rate is the one you start first. And then you begin to make the minimum payments on all your other accounts, and every extra dollar you pay towards that first one with the highest interest rate. That's what you do with the debt avalanche. Now, and then you continue till all the debts are, so you pay the top one, that 30, and then you pay the 20. Once that one's paid off, you take all the money you were paying on that one and pay it now to the next one. And then just go on and on and on until all the debts are paid for. The next way is the debt snowball. And this is where you list the debts in order of the amount you owe. And so not what you're paying in interest, but the amount that you owe. Now, mathematically speaking, the debt avalanche makes the most sense to start with. However, as I shared with you at the beginning of this presentation, most people are making decisions about their money based on emotions and based on their beliefs and their behaviors. So the debt snowball actually caters more to someone's beliefs and feelings than it does the debt avalanche. So I tell people, look, if you really want to feel good about getting out of debt and you want to have an immediate win or something that you feel confident about, let's find the lowest credit card first, and let's pay that off. And then you feel good because you've accomplished something. You actually paid that off. And so because you paid it off, you're going to feel motivated to continue down the process. Now, once you get to the point where you're at the credit cards where maybe all the balances are about the same, then I would switch over to the debt avalanche and work on the ones with the highest interest rate, because mathematically speaking, that's going to get you that you're going to pay the least amount of interest by doing that. So I tell people to have kind of a hybrid debt loan payoff, or getting out of debt is in a hybrid fashion, where you start with the debt snowball, pay off a couple of those low-hanging fruits, those real easy accounts first to feel good about it, and then jump into the debt avalanche where you're paying off the ones with the highest interest rate. So pros and cons: you pay less interest at the debt avalanche, and it's the cons of the debt avalanche is, like I shared with you, the visible progress takes more time. Debt snowball provides the motivation to see progress quickly, but you pay more in the long run. So that's why I say you should do a mixture of the two. So I'm going to show you an example really quickly of something that I call the cash flow index. So let's say, for example, that this is an example of what I use to help people understand this. So let's say I have a personal loan at 12%, car loan at 2.9, another car loan at 3.9, a MasterCard at 22, a Visa at 22, almost 23, and then a student loan at 5. So if you were to do the debt avalanche, you would take the highest interest rate, and you would start with that one. So that would be the Visa card would be the first one you'd start with. If you were to do this debt snowball, you take the lowest balance and start with that. So it would be the MasterCard you'd start with. Well, the cash flow index, one of the things that you have to realize about getting out of debt is that the more money that you have to put towards a debt, the faster you can get out of debt. So that's where the cash flow index comes into play. So what you do is you take the total balance that you owe and divide it by the minimum payment that you have, and then that tells you the cash flow index. And the lower the number, the better. That should be the first one you pay off. So let's say, for example, in this situation, if I have a $5,000 balance and my minimum payment's $200, if I pay that off, I'll be able to pay that off fast because it's only 5,000, and I'll be able to free up the $200 to now use towards other things. Where if I just did the MasterCard or the Visa, you can see it's only $25 or $35 is the minimum payment. So the more money that I have freed up, or the more cash flow that I have freed up, the faster I can use to put that money towards other things. So that's where I'm showing the cash flow index for. That's an example of the cash flow index. Hope that made sense. So the fifth step is to shield and protect with insurance. So a lot of people think that insurance is a necessary evil, and it is frustrating to sometimes have to pay for insurance because you feel like you're not going to be able to use that. But I promise you, I'd rather have insurance and not need it than need it and not have it. So the first types of, there's 4 primary types of insurance: liability insurance, property insurance, health insurance, and life insurance. And auto insurance is under property and insurance. That's where you can, obviously we all know about having a car insurance and auto insurance in case you get in a car accident or something gets stolen, lost, or stolen. Renter's insurance, not a lot of people know about this because it's not as common, but if you rent and have an apartment and somebody robs you and you have no renter's insurance, you basically lost all those things. So part of insurance is also, in my opinion, part of an emergency fund, because if something bad happens to you that you're not really prepared for or planning for, the insurance can make up the difference. So insurance is a significant part of being prepared and planning properly. Homeowners insurance is for all kinds of things to do with if your house burns down or if you get somebody gets hurt on your property. Important to have homeowners insurance. You could be sued very easily and lose a lot of money if you don't have the right kind of homeowners insurance. Health insurance is critical, as we know that health concerns come up. So make sure you understand that you're getting the right things there. You're getting the right deductibles, the right coinsurance, copays, understand all those things. Now, something that I offer is called a medical savings plan. There's certain medical savings plans that are more efficient than others. There's things called a health savings account, which is very popular, very familiar for a lot of people. The HSA is very popular. I actually offer a medical savings plan that I believe is even better than the HSA. It's called the health matching account. So contact me if you want to know more information about that. You can you do that at either leave a comment below or email me at paris@financialselfreliance.net. Now, Medicare is another part of insurance that for the older folks that once you turn 65, you qualify for Medicare Part A and Part B. Or if you're disabled for 24 months, you can qualify for Medicare, and then Medicare takes over as your health insurance. Life insurance is a critical part of your whole overall plan. There's one thing that I tell people that, a lot of people joke with me because I've been a life insurance agent for 20 plus years. They say life insurance should be called death insurance because you don't get the money until somebody dies. And so I agree. That's kind of a funny thing, but the reality is that life insurance is not necessarily for you. It's for those that you leave behind to make sure that they have the bills to continue to live the lifestyle that you want. The goals and dreams that you had set up will be cut short if you don't have money to be able to fund those dreams, and your income is critical in determining that. So life insurance is critical. Let's just jump into long-term care insurance. I just actually had a lady, client of mine call me up and say, "Hey, Paris, I need to put my mom into a convalescent home. What can I do for that? Does Medicare cover that? Where do I go to get the insurance necessary for that?" And I said, "Well, that's actually called long-term care insurance. Did your mom ever buy that?" And she said, "No." And I said, "Well, then unfortunately, you're going to have to go a different route because long-term care insurance is actually becoming more and more popular as we age and as we become disabled. And as a lot of people have opportunities to spend time in convalescent homes or homes, that long-term care insurance can be critical. So make sure that you're looking at that if you're young, especially if you're young. You don't want to get it when you're old. Then umbrella policies. So if you get sued, you want to have an umbrella policy that's going to take care of everything, or that kind of those catch-all things. So if you have car insurance that gives you a certain amount of coverage and you may feel like you want to have even more coverage, then an umbrella policy will give you even more in addition to what the car insurance gives you, especially over and above your homeowner's insurance. So I have an umbrella policy that gives me an additional $1 million of coverage over and above what I have on my car insurance, over and above what I have on my homeowner's insurance. So I have all of the coverage that I have under those, and then I have an additional $1 million as an umbrella policy. So I highly recommend that you take a look at umbrella policies, which are really, really good to have. So the sixth step in creating wealth or creating lasting wealth is actually building the wealth and retiring on time. So we've learned how to keep everything that we've talked about so far is really learning how to manage and protect. So managing your money, and by having your proper mindset, having the cash flow, understanding what's coming in, what's going out, protecting it with savings accounts, with insurance, and getting out of debt, managing it properly, getting out of debt, maintaining and managing that debt, and then building wealth on retirement. This is a critical step here. Why people invest. Some of these slides, actually, I'm feeling like I should probably skip over, so I'm going to do that. But one of the things why people invest is to become financially secure, to attain financial independence, to be able to retire one day, and to be able to live a lifestyle that they don't have to work anymore. That's really some of the biggest reasons why people invest, especially when they think about creating passive income. Passive income is that income that you can build up something and then have that continue to pay for you over time. So, that comes with the types of investments. So what kinds of investments are there? Cash is actually an investment that is really good to have, especially right now as we're heading into a recession. You want to have a lot of cash on hand as the value of things start to come down. You want to be able to have that cash available to be able to buy these assets. The best time to buy assets is when the prices are low, and having money in cash is a really good time is really good thing to do. So some of the more common things is the stock market, real estate, and business ownership. I built my first passive income stream as a business owner. And so I have a book of business now as an insurance agent that pays me a significant passive income. So my goal in starting this channel was to see if I could do it again with creating a passive income with my YouTube channel, creating a passive income within the stock market, and then eventually get to the point where I can have a passive income in real estate. So the three most common investments are those three areas. And then you can drill into each one of these and get more specific, with each one. So a lot of people, when they think about retirement plans, they think about their job, the traditional, Roth IRA or the traditional IRAs that you can see out there and find out there. So the difference between a Roth IRA and a traditional IRA is how it's taxed. And so that's important to realize that if you want to have a Roth IRA, contributions are made with after-tax assets. So you earn your paycheck, you've paid the IRS already, you take the money and then you put it into the Roth IRA. And then as long as you follow the rules, you can pull that money out tax-free. Then the traditional IRA, you get to actually, whatever you put into it, you get to reduce your gross income by the amount of money that you put into it. There's limits to how much you can put into a Roth IRA or a regular IRA. And then once you tax the money, once you pull the money out, it's taxed as ordinary income. Now, I personally have done the math on a lot of these scenarios, and I believe that tax-free is better than tax deferred or taxed later. We don't know where the tax code's going. And if you follow the history, most people that I ask, where do you think taxes are going? Up, down, or are going to stay the same? Most people say they're going to stay the same, or they're going to go up. And if you're paying more taxes later, why would you put money in an account that you would then end up paying taxes later? Because to me, this didn't make sense. If you know taxes are going up or you feel like taxes are going up, why would you put money into an account where you're going to pull it out later and pay taxes at that higher rate later? Why don't you pay the taxes now, get it over with, and then start to save and invest your money so that you can then have that opportunity to have that come to you tax-free? So 401k plans are pretty popular. 403, and that's with a traditional corporate job. If you have a corporate job, then you're going to have a 401k or a pension. If you have a job where you're maybe a teacher, or you work for a church, or you work for a nonprofit organization, you're going to have a 403b. And then business owners have solo 401ks, defined benefit plans, simple IRAs, things of that nature. So those are the traditional plans. So it's like I shared with you, how your money is taxed would determine where you should put it. So I highly recommend that you sit down with a CPA or somebody that's a financial professional that understands, at least at a basic level, the tax implications of every place that you could put money and can give you the proper advice there. So one of the things that's critical about investing is making sure that you're getting a good rate of return. So getting good rate of return means that you take your current principal, which is the amount you invest, plus any additional investments, plus how long you have to grow, and then what's the annual rate of return you're going to get. Now, the rule of actually, let me just jump here to where it talks about the rule of 72. The rule is if you have an interest rate that you're earning, you can divide that into the number 72, and that will tell you how many years it will take for your money to double. So if you have $10,000 in savings, then it earns 10%. 10 into 72 is 7.2 years. So your $10,000 will double to $20,000 in 7.2 years. So the idea here is to get the highest interest rate possible with the least amount of risk so that your money has more time to compound and grow. And so that's part of what's critical here with growing your wealth, is getting the right interest rate. At the bank, you're going to earn 0.01%, which is going to, if you divide 0.01 into 72, that's like 7,000 years before your money doubles. So that's why it's ridiculous to put your money in a bank, in a savings account. Get a high yield savings account earning 3 or 4%. That way you at least have a chance to have that money grow and double for you. Get your money into the indexes, get your money into the market. That way it has a chance. Get your money to real estate, grow and develop a business. Get that money growing for you so that it's earning double-digit returns so that you have a chance to have that money grow and develop for you. So one thing that you want to do on a regular basis, or at least I think that you should do, is assess your net worth. Now, your net worth to me is your report card. It's your financial report card. After you've left school, what is your new way to determine if you're doing well in life? Well, in school, your report card, if you're doing well in school, you're going to get A's and B's and maybe some C's. But if you're not doing well in school, you're going to be D's and F's. So in real life, your net worth is it determines how well you're doing. So if you have a positive net worth, you're getting A's and B's. If you have a kind of a break-even net worth, you're probably getting a C or a D. And if you have a negative net worth, you're basically getting a D or an F. So your net worth is you taking all your assets and you calculate all your assets, your home, your cash, your bank accounts, your retirement, your savings, your stocks, your vehicles, everything, add it all up, and that's your assets. And then take everything that you owe. So all the money, so this is what you own, and this is what you owe. So you take what you own, add it all up, and then take what you owe and add it all up, and then subtract what you owe from what you own, and that gives you your net worth. So it's important to calculate your net worth so you know, as I shared with you, that's your financial report card. So here we go. We talk about liabilities: mortgage, credit card, auto loans, student loans, personal loans. So here's an example. If all of your assets are 6,500, pardon me, if all of your assets are 65,000 and you have liabilities of 6,000 and 10,000, you take the total assets of 65,000 minus the total liabilities of 16,000, and your net worth is a positive 49,000. If you can get to, so a positive cash flow will lead to a positive net worth. If you have a negative cash flow or a break-even cash flow, you're either going to have a negative net worth or you're going to have a break-even net worth. And if you have a negative net worth, you're not doing it right. You want to get to the point where you have a positive net worth, and then you want to grow that positive net worth as much as you possibly can. Finally, the 7th step is leaving a legacy or estate planning. I'm going to crank through this in the next 2 minutes so that we get this done in under an hour. But I really appreciate you spending the time with me today and being here with me to kind of help me practice this presentation. As I've gone through this today, I've realized there's a couple of slides that are probably too much for the presentation. So I'll be able to bring that down and knock that down and make this a much faster presentation as I get better practice with it. So I appreciate you sticking with me, a couple of you there to the end here. So this is the final step in financial planning. Now, a lot of people will train you how to build wealth, manage your money, get out of debt, build your wealth so that your life is taken care of. However, most of us, as I've talked with people in their life, I ask questions like, especially to seniors and people that are getting a little bit older in life, I ask them questions like, what would you like to leave this when you leave this world? What would you like to have the world remember you for? What would you like to have as a legacy, or what would you like to have as a memory of who you are and what you are? And I don't know where we lost this, but in ancient times, your name and who you were and having children and grandchildren, that was very significant. In fact, it was almost like people religiously speaking, they felt like they were blessed if they had a lot of children. They could carry on a legacy of their name, family name. And they felt like they were cursed if they had no kids and they had nobody to go, carry on that family name, that family traditions. That was a curse. I felt like that was a curse. So I think leaving a legacy is something that's kind of been lost to the ages. And I'd like to help bring that back. And as we develop a plan for our financial life, What do you want to do? Because there's only, as they say, there's only two guarantees in life. One of them is taxes, and the other one is death. So let's plan for your death. Nobody likes to talk about planning for your death, but the reality is we're all going to die. So what do you want to do? What do you want to? How do you want to leave this world? Do you want to leave it a better place than you were here? There's some people that I've talked to. They're like, man, I struggled through life, and when I go, the next generation, they're going to struggle just like me. They got the same thing as me. Well, there's a lot more people, and I feel this way myself, that, if I struggle through life, I'd like to leave something so that the next generation doesn't have to struggle as much. Now, struggle is what creates or causes us to have the strength of character. What builds our integrity. Struggle is what gives us the knowledge and the wisdom and the experience of life. And so struggle is part of it. I don't believe in removing struggle. I think that's a lot of the problems. One of the big problems that I've found, that most millionaires who are first generation millionaires, they give so much to their kids that they kind of make them soft, and those kids they're not strong enough to carry on that money. In fact, a statistic shows that within 2 generations, most millionaires' wealth is gone. It's completely gone because the next generation didn't know how to manage it properly. And so it's important to make sure you're leaving a legacy and you're planning properly for your passing, and leaving that something for your children and grandchildren, or maybe for a charity. So estate planning, you want to get a will, power of attorney, medical directives, living trusts. So wills, power of attorneys, medical directives, living trusts are all done by lawyers. Life insurance is an insurance agent. Organizing records and beneficiary directives, that can be done with a CPA or a lawyer. So there's a team of people in estate planning that you got to get together with: lawyers, CPAs, and insurance agents or financial planning professionals. So there's not very many one guy that can do everything for you. You got to have a couple professionals in your team, in your mastermind team is what I call it, to help you with this estate plan. You want to put your will is important. And in fact, a will it can be within a trust. And in certain states, you can actually just write down the things you want and sign your name, and that will help you. A lot of the problems is if you get to a point where you have a large enough estate, the estate taxes will come in and wipe away tons and tons of money. In fact, if you don't have a trust in place, you could actually lose half your estate to the state estate taxes or probate fees, because it may take a long time. If you don't have a will or a trust, your family's fighting over who gets what. They're going to take it to court. And matter of fact, my wife, who's a court reporter, was just telling me about how this family, she just literally is doing, as we're recording today, she's actually doing one right now, where a family is arguing and fighting over the dad died. And so the new wife is fighting with the kids about who gets what. And so if you had a trust, if you have a will, all of that stuff can be ironed out very simply and easily. And there's not a lot of heartache and pain and fighting and arguing and just the stress that comes with that. So having a plan in place is critical. Durable power of attorney, that's where you give permission to somebody. If you become disabled or incapacitated anyway, you have somebody that you trust that can make those decisions for you, whether they're financial, medical, or otherwise. Medical directives are like do not resuscitate. So if you get to the point where you're in a vegetative state, or you're in a position where you're on life support, do you want to continue that way? Or do you want to just say, you know what, let me go, cut the cord, I'm out, and I want to move on? So you need to have that in writing, in place, before you get to the point where you need it. And then beneficiary directives, like on your life insurance, who's your beneficiary? So if you've been married and you had your wife as or your husband as the beneficiary, and now you've divorced and you're remarried, you better change that, because the old spouse is going to get the money unless you change it to the new spouse. Or they say you divorced and you're done with spouses and you want to make sure your kids get it. You got to change the beneficiary to your kids so that your spouse doesn't get that money. Otherwise, they're going to get it if they're still listed as the beneficiary. And then having a living trust is critical, and naming people to help execute that trust for you. All right. Well, that's it for today. I want to thank you guys so much for being on with me and going through this process with me and helping me learn how to give this presentation. Thanks again. And I hope you got a lot out of this. And if you did, then great. If not, come back and hopefully ask any questions you might have, and we'll move forward with it. But I appreciate you being here, and look forward to seeing you on the next one. Take care. Thanks.